Good morning, viewers. This is Renuka. I am working as an assistant professor in Dr. SNS Rajalakshmi College of Arts and Science. I belong to Business Administration Department. In this video, we are going to discuss about the tax liability. So, it's nothing but the detailed explanation only we are going to check in this video. Okay. So, the tax liability refers to the total amount of tax that every individual person, not a group, it is a all individual person and business doing persons or any organization is legally obligated to pay the government within a specific period based on their income they earned during the particular year. It arises based on taxable income. It is applicable as per the tax law, the nature of the financial transaction undertaken during the financial year. So actually the understanding of the tax liability is very essential for proper financial planning, compliance with legal requirements and avoiding the penalties. So any individual level, we are talking about the individual tax liability. It is actually determined by income earned from various sources such as salary, then house property. Some people they might be given and receiving the particular rental income from their own property, or some people they might be doing the business or capital gain and interest. So these are all income from other sources earned by the individual person. So these all topic we have to discuss earlier in the previous videos. Okay. The governments typically define tax slab or tax rate is nothing but the individual persons are taxed according to the income they fall into. For example, higher income level. Okay, we are taking about the high level people income earned. They are generally attract higher tax rate under the progressive tax system. For business people, the tax liability is nothing but it might be incorporates the corporate tax on the profit as well as other obligation. They might be like goods and services tax is nothing but the GST. Okay. So the payroll taxes, customs duty, whereas applicable, it's defined as the tax liability. When we are talking about the some individual financial records will be maintained by the people to calculate the taxable income after deducting the allowable expenses such as operating cost, depreciation and interest payment if applicable. Next we move to the calculation of tax liability. Suppose if you are going to calculate the liability of tax, it involves many steps. So now we are going to see about the several important steps only. Okay. The first of all we take the gross income is determined by the overall income sources we have to sum up. Then we have to go for the deduction and exemption permitted under the tax law or subtracted to arrive the taxable income. The deductions may include investment in specified instruments or insurance premium or education expenses or charitable contribution. So these all after determining the taxable income, the applicable tax rate is applied to the compute the tax payable. The finally tax credit in case it are deducted from the total tax amount to arrive at the final tax liability. So it's actually reduced legally through proper tax planning. It involves organizing the financial activity. You people may ask, what is a tax planning? So before we are going to pay the tax, at the time how we are going to reduce or minimize the tax burden. Okay. while complying with the law, we have to try to reduce or minimize the tax burden. Okay, the common strategies which include investing in some tax saving instruments or claiming deduction or utilizing the exemption and choosing appropriate business structure. So based on that only we have to calculate the tax liability.